Bismillahirrahmanirrahim. Selamat datang ke Bank Negara Malaysia bagi sesi taklimat laporan tahunan 2014 dan laporan kestabilan kewangan dan sistem pembayaran 2014. The annual report will provide our assessment of the outlook of the global economy and the domestic economy, and the initiatives taken to address our areas of vulnerability and to strengthen our economy. The Financial Stability and Payment Systems report, also being released today, will cover our assessment of the stability of the financial system and the policies and financial reforms implemented during the year. So we're very pleased to welcome the members of the media here today on this occasion of the release of our two reports. We have actually already had a press conference on 2014, so most of the presentation today will be on the issues relating to the outlook of 2015 and our assessments of the environment and its implications on us and the thrust of our policies. As we all know, the Malaysian economy continued to remain on a steady growth path in 2014 and recorded a stronger growth of 6%, one of the fastest growing economies in the Asian region. The growth was mainly driven by the continued strength of private demand, and it was supported by an improvement also on the external trade. In 2015, while the external environment is expected to improve, growth in the global economy is projected to remain modest. Yes, there will be an improvement, but it is still of moderate growth. Global growth will be supported by improvements in several of the advanced economies and sustained growth in most of the emerging economies. The lower global commodity prices and accommodative monetary policy will also provide support to the global growth. The growth in the number of major economies, however, and in particular is the Euro area and Japan, will however still remain subdued amid prevailing structural weaknesses. And in others, it is the result of structural adjustment efforts taken to rebalance their economies and to rebalance their key drivers in the economy. In Asia, growth is projected to be sustained by the continued expansion of domestic demand and exports. Of course, the external sector will benefit with the recovery in demand, in particular in some of the major economies, in particular the United States, given that 30% of imports by the United States is from Asia. A significant development during the concluding months of 2014 and the early 2015 was the decline in commodity prices, in particular fuel prices. And in this environment, global inflationary pressures are expected to remain modest. And in 2015, global commodity prices are still expected to remain low, and this is on account of the continued excess supply and modest demand conditions. The subdued commodity prices outlook will in turn contain inflationary pressures to below central bank targets in several of the advanced and emerging economies. Another expected development is the divergence in monetary policy adjustments in the major economies. And we've seen, of course, the European Central Bank and the Bank of Japan, they are expected to increase the degree of monetary accommodation through further asset purchases, while the Federal Reserve Bank could begin the interest rate normalization this year. And despite this expected divergence in monetary policy direction, the overall monetary policy stance is expected to remain accommodative to support the overall growth in the global economy. Notwithstanding this outlook, downside risks in the global economy has re-emerged, and this is something that we have to take into account in terms of our external environment. The prolonged weakness in domestic demand and the persistence of disinflation or even deflation could result in weaker than expected economic activity in several of the major economies. Uncertainty in the policy environment in the major advanced economies, particularly in the timing of their policies and the extent of their policies, together with the volatility in the commodity prices, could contribute to increased volatility in the international financial markets. And uncertainty in these commodity prices could also affect growth prospects in a number of commodity-producing emerging economies. The emerging economies, including Asia, are also expected to remain susceptible to large and volatile capital flows, given that the likely shifts in global liquidity during the year. So in early 2015, the reversals of capital flows experienced by most of the emerging economies, including in Asia, has contributed to exchange rate depreciations during this period. Most, however, have demonstrated resilience in the face of these outflows. The Malaysian economy, against this environment, is expected to remain on a steady growth path, and our projections is that it will increase in the range of 4.5 to 5.5% with a midpoint rate of 5%. Domestic demand will continue to anchor economic growth in 2015, driven by private sector spending. All economic sectors are expected to expand, with the services and manufacturing sectors remaining as the key drivers to our overall economic growth. The external sector is also expected to contribute to growth, following the expected improvement in several of the advanced economies and sustained growth, of course, of the regional economies. Now, the economic restructuring and the financial reforms that were undertaken by Malaysia have accorded us the resilience to weather all these challenging external environment. The Malaysian economy has now become more diversified while advancing into higher value-added activities. The overconcentration and dependence on any one particular sector has been substantially reduced. The resilience of the economy on the reliance of the economy on primary sectors like agriculture and mining has continued to decrease from 33% in the 1980s to now only 15% in 2014. Growth is also now domestic demand driven as compared to previously when we were export-led. A more developed and resilient financial system has provided important support to growth. Growth in domestic demand is projected to register 6% in 2015, primarily driven by private sector spending. On the supply side, all economic sectors are expected to continue to expand in 2015, with growth underpinned by the services and manufacturing sectors. Growth in the services sector will be supported by consumption and trade-related sectors, while the manufacturing sector is expected to be supported by the continued growth in export-oriented sector, particularly electronics and electrical sector. Growth in the mining sector is projected to be sustained amid the output from a new oil field. Meanwhile, the agriculture sector is expected to record a lower growth, weighed down by the lower commodity prices. The construction sector is expected to continue to remain robust driven by activity in the residential and non-residential subsectors to have a growth of projected to be 10.3%. After 5 years of above average growth, private consumption is projected to increase by 6%, supported by stable labor market conditions, low unemployment, and continued salary growth. The household spending will further be supported by higher disposable income arising from potential savings estimated to be about 7.5 billion ringgit from lower fuel prices, and by government measures to supplement incomes of targeted groups. There will, however, be a temporary period of adjustment by consumers following the implementation of GST, and this moderation was observed in most of the other countries during the initial period of GST implementation. I should add that more than 160 countries in the world have implemented the GST, and certainly we can draw on their experience. The lower earnings of commodity sector also will have some effect on consumption spending. Private investment is projected to expand by 9% in 2015, driven by private investment in the services and manufacturing sector. And I should mention that 77% of private investment is from the manufacturing and services sector. And this will offset the lower capital spending in the mining sector in an environment of lower oil prices. Record high manufacturing investment approvals also recorded in 2014, amounting to 71.9 billion ringgit, points to sustained prospects for investment growth in 2015 and 2016. 2014 was particularly high in terms of approval, almost 72 billion as compared to 52 billion in the year before. Now turning to fiscal position of the country, the government, fiscal reform measures have contributed to an improvement in the fiscal position. And we've seen from the chart here that in 2009 we had a fiscal deficit of 6.7%, and this has improved over the years from 5 to now 3.5% for 2014, and projected to be less in 2015. And the earlier fiscal reforms have included to reduce the dependency on oil revenue, and this has declined significantly. Expenditure on reforms is underpinned by the removal of fuel subsidy, which reduces the operating expenditure. And then, of course, the GST implementation will broaden the revenue base. The implementation of these key reform initiatives includes revenue enhancement measures, and they have diversified and reduced the fiscal dependency on oil-related revenue. Expenditure reform measures underpinned by the removal of subsidies have also contributed to reducing the operating expenditure. Turning now to the external sector, and this is also an area of interest, especially on our current account surplus. Growth in exports is expected to be affected by the lower commodity exports, while manufactured exports, which are driven by the electronics and electrical sector, are expected to benefit from the improvement in the major advanced economies. Growth in imports is projected to expand further, and this is due in part to growth in the intermediate and capital imports. And this is important as production in electronics industry in particular and electrical goods, the intermediate goods is imports is a sign of continued expansion in these industries. And then, of course, the capital imports reflecting the increase in investments in the manufacturing and services sector. for 2015, the trade balance is expected to narrow, but it will still remain in a substantial surplus amounting to 53.6 billion. The diversity of Malaysia's exports across products is reflected in the fact that manufactured exports account for 77% of our total exports. And this sector has also been progressively diversified to fast-growing segments of the industry. And while the exports to advanced economies remain important at 29% of our total exports, this is substantially reduced from 2005, where it was 40%. Malaysia now has strengthened its trade linkages within the Asian region, which now accounts for 50% of our total gross exports. The narrowing of the current account surplus of the balance of payment also reflects the rebalancing and structural transformation of our domestic economy. For 2015, the current account balance is expected to remain in surplus at 2 to 3% of GNI, and the lower goods surplus followed the considerably lower commodities prices and the higher deficit in the income account. The services deficit, however, is projected to improve, supported by the recovery in the tourism activity in Malaysia. The current account balance may, during some quarters, be affected by seasonal trade patterns, which would not be reflective of the overall strength of the Malaysian external balance. This trend, of course, also, as I have mentioned, reflects the significant rise in investment activity. While savings grew by an average of 6.1% in 2010, gross fixed capital formation grew faster at an average rate of 10.1%. These investments were mostly undertaken in the new growth areas, high value-added industries, and infrastructure that will further lift Malaysia's productive and export capacity in the future. Total savings, however, continue to remain high, and this is important, averaging 33.2% of GNI between the years 2010 and 2014. And turning now to the exchange rate, since September, the ringgit has depreciated by 14.4% against the US dollar during this period. External and domestic uncertainties have affected the movement of the ringgit. And despite this depreciation, the adjustment in the nominal exchange rate against major trade partners has not been significant. It has only depreciated by only 6.2% since September of 2014. Malaysia has experienced episodes of large capital outflows before, and of course these are the factors that affect the performance of the currency. During the global financial crisis, the outflows of 39.3 billion US dollars between 2008 and March of 2009. And during the first indications of tapering by the Federal Reserve Bank between May and August of 2013, the outflows amounted to 19.1 billion. So from time to time, we see these episodes of outflows. Of course, prior to these episodes of outflows are surges of inflows that cause our exchange rate to appreciate significantly. But what is important is, despite this volatility in capital flows, conditions in our domestic and foreign exchange markets have remained orderly. There's been no disruption to financial intermediation, and this is largely due to the fact that our financial intermediaries, particularly in the banking system, remain strong and resilient, and the more developed financial markets. And finally, it's important to emphasize that during each of these episodes of outflows, there was no dislocation to the underlying economic activity. In this environment, the international reserves amounted to $110.5 billion as at end February this year. And this represents actually a five-fold increase since the Asian financial crisis. The reserves to short-term external debt coverage is 1.1 times and is adequate for a country with a relatively high degree of financial openness. Malaysia also has a high degree of financial openness as reflected by the high presence of non-resident participation in our financial markets and increased regionalization of our banks and the progressive liberalization of our capital account. The high level of international reserves, together with the more flexible exchange rate, will continue to serve as an important policy buffer against potential external shocks. In assessing the risks associated with short-term external debt, the following consideration needs to be taken into account. 63% of the short-term external debt are held by the banking sector, due largely to the centralization of the commercial banks' foreign currency liquidity management. 17% comprises non-resident holding of money market instrument, mainly Bank Negara monetary notes, and these instruments are used by the bank in its monetary operations to absorb excess liquidity in the banking system. So in event of outflows and withdrawal of liquidity, obviously we are in a position to unwind these positions. And the remaining is mainly trade credits and short-term intercompany loans, of which these are largely backed by export earnings. Therefore, in our assessments, risk emanating from external indebtedness remains manageable. Turning now to inflation. Headline inflation is expected to average lower between 2 to 3% in 2015, and the lower global oil prices are expected to reduce domestic fuel prices through the managed float fuel pricing mechanism. Since the implementation of the managed float pricing mechanism for fuel up to March 2015, fuel prices have been lowered by 25 to 35 cents per liter compared with November 2014, contributing 1.4 percentage points to the decline in headline inflation. The lower domestic fuel prices will benefit households through the higher disposable incomes. The estimated increase in household disposable income as a result of this decline in fuel prices is 7.5 billion ringgit. Monetary policy in 2015 will focus on ensuring steady growth amid a contained inflation outlook. Financing will continue to remain supportive of economic activity with higher financing through the banking system, the development financial institutions, and the capital markets. In 2014, loans disbursed in particular to SMEs by both banks and development financial institutions continued to be strong, amounting to 239 billion ringgit in 2014. Funds raised in the capital market was also relatively stable, amounting to 101.3 billion ringgit despite the volatile market conditions towards the end of 2014. Ample liquidity conditions continue to ensure the availability of financing for productive purposes, and outstanding surplus liquidity with Bank Negara Malaysia remained high at 270 billion ringgit. And of course, therefore, these amounts can be unwound during the course of the year should there be further outflows of liquidity. Financing costs have remained low for the private sector, And the low cost of borrowing is not only confined to large corporates, SMEs are also able to obtain financing at an average rate of under 6%. And finally, in summary, despite the uncertainty surrounding the global outlook, the Malaysian economy is projected to remain on a steady growth path of 4.5 to 5.5% in 2015, driven by the strength of our domestic demand. This is reinforced by the economic diversification and ongoing structural reforms and adjustments of the economy. It's also supported by the accommodative monetary policy, the pro-growth measures, including targeted assistance to vulnerable segments of the economy, and improved access to financing, in particular by SMEs. Other fundamentals include the current account of the balance of payments projected to remain in surplus, headline inflation projected to range between 2 to 3%, and the more developed financial markets and ample international reserves have accorded important policy flexibility and to avoid the destabilizing effects of these external developments on our economy. Now, in conclusion of the first report, that is our annual report, I just want to highlight Bank Negara's financial position, as the tradition is to do so. As at 31st December, our total assets amounted to 427.6 billion ringgit, and out of our net profit realized during the year of 6.38 billion, 3.35 billion was transferred to the risk reserves, 3 billion was declared as dividends to the federal government, and the remaining 35 billion was transferred to the General Reserve Fund. Let me now turn to the second report, which is to the Financial Stability and Payment Systems report. Domestic financial stability was preserved in 2014, and this is expected to be sustained in 2015. This will be supported by the high degree of resilience of the financial institutions, as demonstrated by the strong capital and liquidity buffers, continued prudence in risk-taking, and improvements in risk management practices. Also, the orderly conditions in the domestic financial markets despite the volatile capital flows. This will contribute towards the effective functioning of the financial intermediation to support economic activity. Growth in household debts. This is an area that was focused for a number of years now. So growth in household debts have now moderated over 2 consecutive years to the slowest pace of growth of 9.9% since 2010, and this was largely attributed to the significant moderation in growth of personal financing by non-bank institutions in particular, which more than halved to 5.3%. Aggregate house prices recorded 3 consecutive quarters of slower annual increase since the end of 2013 to 8.4% in the second quarter of 2014. The incoming supply of affordable housing units is also expected to reduce the pressure on house prices over the medium term. Supported by the sustained financial and balance sheet strength of most businesses, including government-linked companies, the credit risk from exposure of the business sector has continued to remain largely stable. The aggregate leverage position of businesses have remained low at 42%, with a healthy interest coverage ratio of 6.4 times. External borrowings also grew at a negligible pace, that is less than 1%, compared to in 2013, when it increased significantly by 22%. Most of the borrowings relate to intra-group funding by large corporate groups and are backed by foreign currency receivables, which act as a natural hedge against foreign exchange movements. the bank's stress tests on large corporations, which simulated severe earnings, foreign currency, and funding shocks on individual firms' balance sheets, demonstrate that the strong financial buffers of most large borrowers would be sufficient to support debt obligations, thus resulting in limited spillovers to the financial system. Similarly, the likelihood of default incidents in the oil and gas sector is assessed to be limited at about 0.2 of excess capital of banks. The potential contagion risk arising from external exposure of financial institutions also continues to be limited. External exposures increase with the expansion in intra-regional trade and overseas operations of domestic banking groups, and these trends are also reflective of the more centralized management of foreign currency funding and liquidity rather than an increased reliance on offshore funding for operations in Malaysia. In fact, this is, of course, negligible. The overseas operations of domestic banking groups continue to record sound capital and financial performance with a stable funding profile supported by local currency deposits. The banking system foreign currency funding gap has remained small at less than 1% of total capital, with surpluses recorded in US dollar liquidity at the end of 2014. The regulatory and supervisory framework has continued to be strengthened in 2014, and since the implementation, and this is mainly, of course, this is important both in terms of reforms for the insurance and Takaful sector have continued to be important priority to promote efficiency, enhance protection of policyholders, and ensure sustainability of the insurance sector. Since the implementation, and this is all for the insurance sector, since the implementation of the new motor coverage framework in 2012, significant improvements have been observed in the claims settlement process. Gradual premium adjustments have been undertaken will pave the way for the transition towards market-based pricing for motor insurance. And in the life insurance sector, the phased implementation of the life framework will commence in 2015, that is this year, and a comprehensive set of measures will be implemented to provide wider access to life insurance and Takaful products to the public. The financial markets during the year has continued to support funding and risk management needs of corporations. The Malaysian debt securities market has remained the largest in Southeast Asia at over 1 trillion or 104.4% of GDP in value outstanding as at end 2014. And I would mention also the largest renminbi bond market in Southeast Asia, valued at 1.5 billion renminbi, was issued during the year by Cagamas Berhad, adding further to the breadth of our market. The average daily turnover in the foreign exchange market has also increased to 11.8 billion US dollars. To promote the wider use of renminbi, facilities for banks to manage short-term renminbi liquidity in Malaysia was expanded, and the designation of a renminbi clearing bank in Malaysia, the first for an emerging economy in Asia outside China, also provides another option for corporates to manage their renminbi transactions more efficiently. And the enactment of the Netting of Financial Agreement Act in 2014 will make us a netting-friendly country and will further contribute towards enhancing the overall liquidity of the financial markets, affirming Malaysia's status as a netting-friendly jurisdiction, therefore lowering the cost of derivative transactions for managing foreign exchange and interest rate risks. Arrangements for the consumer protection continued to be strengthened during the year. The transformation of the Financial Mediation Bureau to a financial ombudsman scheme is now well advanced, with a new scheme expected to be in operation by June of this year. New requirements relating to consumer obligations to make relevant disclosures to their insurers will further enhance the protection of insurance policy holders. In the area of financial inclusion, further progress has been made to improve access to financial services for all segments of society. In 2014, Malaysians and districts were provided with convenient access to financial services either through bank branches or agent banking. SMEs continue to have access to financing. To date, 239.5 billion in financing has been extended to 735,000 SMEs. Bank financing to SMEs has been sustained at 45.8% of total outstanding loans to businesses. And microfinance, insurance and takaful products were piloted to address the specific needs of low-income and underserved segments. With the conclusion of the sixth package of financial sector commitments under the ASEAN Framework Agreement on Services, described as AFAS, and this is expected to be signed off in this quarter, the ASEAN banking integration framework can be taken forward. And in enhancing the efficiency of a cross-border trade settlement, Malaysia is amongst the first group of ASEAN countries to adopt the principles for product transparency and disclosure on cross-border trade settlement. And the principles will enable timely access to information on charges and services levels offered by the financial institutions. Efforts continue to enhance the vibrancy of the Malaysia's Islamic finance marketplace, and these efforts have further strengthened Malaysia's position as an international marketplace for Islamic finance. And during the year, the world's first yen-denominated sukuk was issued out of our market. There has also been a notable increase in the adoption of e-payments for the retail payment transactions. We're very pleased that the use of checks has now declined by 10% in 2014. For many years, this has been stable or on an increasing trend, and now it has declined by 10%. And the number of interbank gyro transactions has increased by 36% compared to only 19% in 2013. So the bank, together with other the banking industry, continues to undertake efforts to drive and sustain the adoption of e-payments. And this involves extending affordable interbank gyro services to ATMs and self-service internet kiosks, requiring banks to publish details of e-payment services to promote transparency and competition, building a greater awareness and confidence in e-payments through media campaigns, roadshows, workshops, and so on, and requiring financial institutions to consider the risk management strategies that need to be in place to manage risks arising from cyber threats. And finally, the bank has continued to pursue collaborations with the financial services industry to raise the supply and quality of financial professionals. And this is important because the quality of our financial services industry has increased with the increase in quality of the professionals that serve the industry. In 2014, the Financial Services Talent Council was established, to further strengthen the confidence and professionalism in the financial sector, the Financial Services Professional Boards was established to develop and advocate for the adoption of high ethical and professional standards for professionals employed in the financial services industry. Right, so this concludes the presentation on for the two reports. I would like now to make an announcement, and this announcement relates to our Monetary Policy Committee. I just want to give you a background of the performance of the committee. In 2002, the Monetary Policy Committee was first introduced. In 2003, we released a monetary policy statement immediately upon conclusion of the Monetary Policy Committee meeting. In 2004, we had reference to the OPR with the introduction of the new interest rate framework during that year, that is 2004. And in 2005, we gave an advance calendar for the Monetary Policy Committee meetings that was released for the first time. In other words, you know the date a year in advance of our meetings. In 2009, we enacted a new central banking legislation, that is the Central Bank of Malaysia Act of 2009, where we have the formulation of monetary policy without any external influence, and this makes reference to, of course, the independence of the central bank in its monetary policy determination. And today we have an announcement, a further change and in the evolution of our committee. Our committee has been made up thus far of internal members, and these members are appointed by the governance committee of our board, and they are selected according to their expertise and background, so that we look at the different aspects of the economy and the environment and the financial system in formulating monetary policy. So today, Bank Negara Malaysia wishes to announce the appointment of two external members to the Bank Negara Malaysia's Monetary Policy Committee. And I wish to announce the appointment of Dr. Nur Azlan Ghazali and Dr. Yea Kim Leng as external members of Bank Negara Malaysia's Monetary Policy Committee for a 2-year term effective 1st April of 2015. And this follows the enactment of the Central Bank Act of Malaysia of 2009, which provides for the appointment of external members to our Monetary Policy Committee. And the Monetary Policy Committee, as you know, is responsible for formulating monetary policy and policies for the conduct of monetary policy operations. Monetary policy is autonomously formulated and implemented by Bank Negara as mandated by the Central Bank Act of Malaysia and 2009. Just as a little bit of background, Datuk Nur Azlan is the Vice Chancellor and Professor of Economics at the University Kebangsaan Malaysia, having begun his career at the university over 20 years ago as a lecturer. And Datuk Nur Azlan specializes in business and financial economics. And Dr. Yea Kim Leng is the Dean of the School of Business in the Malaysia University of Science and Technology. He was previously the Group Chief Economist at the RAM Holdings Berhad, this is our rating agency, having served in the organization for 2 decades, between 1994 and 2014. And prior to joining RAM, Dr. Yea was a senior analyst at the Institute of Strategic and International Studies. So with that, I conclude this presentation, and the team here at Bank Negara Malaysia is very pleased to respond to any questions that you may have.